if we look at the amount of home equity that homeowners are sitting on right now, we're sitting at all-time highs, right? We experienced this big balloon in home prices that we all know has happened from 2021 forward. We've started to see equity levels kind of peak out and flatten out and plateau.
I like to use this example a lot, but there's this emergence of like the HELOC credit card. It dials in on a specific sort of behavioral inertia. It's a HELOC, but ostensibly it's a credit card.
Sure.
Talk about reducing friction. If you can put that credit card on the HELOC at the point of home improvement purchases, or right there. I mean, that's what I've talked to some of these new credit card providers that do HELOCs, is that we want to be right there, so when they're buying their stuff for Home Depot or whatever,
Sure.
they think of the HELOC first before they use their regular credit card.
Hi, everybody. This is Lynn Satterbeal with Upstart, and thank you for joining us again for Leaders in Lending. We are here at CBA Live with Sam Garcia from HELN News, Ivan Ahmed, who is the Senior Director at Experian, and Andy Walden, who is Head of Mortgage Housing and Housing Market Research at ICE. If you could just introduce yourselves a little bit, tell our listeners about what you do.
Sure, I'm CEO of HELN News, and we initially started out covering home equity lending, and now we've broadened out to a little bit more non-agency stuff. But basically the details, the statistics, we curate them all and collect them and report it out in stories about home equity lending.
My name is Ivan Ahmed. I am Senior Director of Product at Experian. I work within the housing vertical. We're kind of a newly created team, but less than a decade old, and I manage all of our prospecting strategies and suite of solutions, particularly around helping mortgage institutions and FIs implement better targeting practices to increase their market share.
Yep. I'm Andy Walden with ICE, Head of Mortgage and Housing Market Research, and I spend a lot of time digging through our various data sets across the organization, whether it's public records data, home equity specific details, lending patterns, buyer behavior, mortgage and line of credit behavior as well, kind of researching what's going on in the market.
Great. Well, thank you. Thank you all again for joining us. I think as we get started, I think it'd be interested to hear, from all of your experience, what you're seeing in HELOC and home equity usage patterns, and particularly as consumer needs evolve. I think the population of who owns homes and who just doesn't own homes is certainly different now than it may have been a generation ago. What are you seeing evolving in just the data usage of those products, and then how would you apply that to banks and how they should be rethinking about their HELOC experience from a consumer standpoint?
Sure, and I can start with a little bit of background on the market. I mean, if we look at the amount of home equity that homeowners are sitting on right now, we're sitting at all-time highs, right? We experienced this big balloon in home prices that we all know has happened from 2021 forward. We were seeing 35% growth in home equity there for a period of time. I think we're kind of in a transition period for the market a little bit. We've started to see equity levels kind of peak out and flatten out and plateau. And so whereas the industry's really been benefiting from all of this equity growth in recent years, we're starting to see that cap off. And now you're starting to see a little bit more of a transition period where we're going to see growth come from expansion of products, expansion of maybe credit risk, those types of things in the market, maybe increased utilization of equity products out there as well. One of the other things that we've seen really take place over the last couple of years is affordability improve for these products from a payment perspective. So when you look at interest rates on lines of credit, they've gone from 10% a couple of years ago down to closer to 7% today. So it's bringing some of that affordability back into the market and allowing more folks to utilize some of those products that maybe couldn't afford it in recent years.
And one thing I'd add is maybe we've seen a lot more non-banks come in and loosen the guidelines, charge higher rates, but make it easier, reduce the friction. So they're kind of a good model for banks to follow if they want to actually reduce friction.
For sure, and I like to use this example a lot, but there's this emergence of like the HELOC credit card. And I think that it really dials in on a specific sort of behavioral inertia around consumers and the fact that they generally opt for more frictionless experiences. I mean, it's really interesting if you sort of double click on that, right? Like, it's a HELOC, but ostensibly it's a credit card.
Sure.
Why is that, right? And so I think it experience and friction matters, and I think in today's age, particularly with the fact that we're seeing an increased capture of market share by fintechs, is that the nimble lenders, the digital-first lenders, the lenders that can create a frictionless experience, as obvious as that sounds, are the ones that are winning the business. I think you had shared some stats around like there is a growing sort of down market trend in market share around, or a gain in market share around HELOCs. So it's some younger consumers are opting for a HELOC more, despite the fact that they generally opt for more frictionless experiences. So I think it's becoming increasingly more important to find ways to address the consumer needs more efficiently. I think the HELOC credit card, I think, is a genius way to do that, for example.
Yeah, I think that's an interesting point. And we have a HELOC product today. We did not have one years ago. And when we were kind of a one-product company and mainly pitching personal loans and installment loans, that was actually part of our kind of sales pitch, was that it was actually a better, even though consumers were willing to take slightly higher rates for the speed of cash in hand for doing something like a bathroom renovation or replacing their HVAC or whatever they needed to do, versus going through all the hoops for a HELOC. They could within as fast as 24 hours have that amount in their bank account. And now obviously we have a HELOC product, so we're innovating on that side of the world. But I think that's a good point. Like the banks and the need for kind of attracting those digitally native consumers, automating things like verification, disclosures, closing. I think the credit card and having that is a great kind of consumer benefit. But what are you seeing from the banks, and like what are they actually doing to both remove friction while also reducing risk and making sure that they're not kind of reducing friction at more of a cost than they expect?
One of the things that we're seeing on our software is putting equity detail in front of borrowers' face, right? Providing more information to homeowners, for lack of a better word, right? We have something called Servicing Digital that sits on top of our servicing platform. And it allows folks to not only see what your payment is every month, what your interest rate, those types of dynamics on your first mortgage, but also see how much equity you have on your home at any point in time. What would the cost be to withdraw that? Does a cash out refinance or a home equity line of credit make more sense to you? So creating those digital interfaces with borrowers and providing all of that information up front to allow them to make the most accurate and insightful decisions as possible kind of up front on some of those loans and lines of credit.
And then I'd like to add to what Ivan brought up, which was the credit card. And, talk about reducing friction. If you can put that credit card on the HELOC at the point of home improvement purchases or right there. I mean, that's what I've talked to some of these new credit card providers that do HELOCs, is that we want to be right there, so when they're buying their stuff for Home Depot or whatever, they think of the HELOC first before they use their regular credit card.
Yeah, and a lot of them are offering like cash back and similar credit card rewards for using that. And then you can also, I think I've seen a number have had either you can kind of do more traditional revolving credit interest, or you can make an option and do some sort of payment plan over a period of time, depending on how you want to structure that, which is a lot of flexibility to offer consumers that we're not always there.
It mimics the benefits of a credit card, but it's very much a securitized, collateralized debt. That's really interesting. And I think when you had mentioned kind of creating platforms to help identify tappable equity or helping consumers understand their options when they're choosing a credit product. On the back end, what we notice at Experian is that lending institutions often don't leverage data to target various markets. It sounds almost obvious to do so, but Andy had shared some other stats too around a concentration in equity in certain geographic markets throughout the U.S. Particularly, again, very obvious in the eastern, kind of the western seaboards. But the fact that that sort of trend exists means that you do really have to be intentional about how you target new markets. So if you're not looking to your own portfolio for growth, if you're looking at external to that, then you have to leverage data to understand where you want to target. And it's not just where you want to target, but how you want to target, why you want to target, targeting with the right products, with the right messaging, with the right sort of risk criteria becomes even more paramount. And
then we have some more information that recently came out about, the demand is coming from the younger HELOC borrowers, but all the equities kind of situated in the older borrowers.
Yeah, typical demand supply.
So targeting the age, mixing in, of course, the equity data, obviously is that much more critical.
Yeah.
Yeah, how are you
Good
seeing
point.
it? This is a kind of a question that came to mind as you were saying that. Certainly with where the interest rates are and have been, we're seeing a lot of maybe retirees who otherwise would have moved not moving, and may have paid off houses or nearly paid off houses. How are you seeing that potentially change the users of HELOC? Are we not quite seeing that yet because they're kind of staying put versus moving into what could be a smaller yet more expensive house?
Yeah, I think you're seeing a lot of it. And I mean, you certainly see it from an interest rate perspective too. A lot of this equity, we always talk about it being a bifurcated market in a number of different ways. This is clearly one of them, right? There are certain demographic impacts here. There's certainly impacts on when you took out your prior mortgage and when you bought your home as well, and splits in the market there where if you bought in 2022 or later, maybe you're not as much of a HELOC candidate because you don't have as much equity and you have a higher first lien interest rate. And then you've got the more legacy borrowers that are sitting on all this equity and have those very low locked in interest rates. So certainly a fair deal of bifurcation across not only demographics and age groups, but when you purchased your home was a big one.
Yeah.
Well, that
Timing
gets,
really matters.
I was going to
Yeah.
say that gets to your point, Ivan, of actually using the data
Yeah.
and knowing your customers and kind of knowing what scenario works for them and which bucket they're in
Yeah.
in that.
And you brought up, some people have paid out their houses. I would suggest that these folks, that group, they have a stigma like, I've got it paid off. I don't want to put more
Yeah.
debt
True.
back on it.
True.
So that's kind of a juggling act there.
They also tend to be cash rich, equity, not mortgage equity, but just equities markets rich as well. So maybe not as in need of some of that equity as maybe some of those younger buyers are. So you see it tend to skew a little bit lower credit score, a little bit younger than maybe the overall equity positions would tell you as well.
Yeah, and I know, it's certainly interesting with HELOC growth. You've seen now Chase re-entering the HELOC market after a 5-year pause, and then Figure, which is one of the newer fintechs who's here, going public. How are you thinking about and working with member banks? How are they kind of recalibrating their strategies? And what are what would you call critical capabilities that they must have to be competitive in the market today?
Well, certainly removing friction is at the top of the list. And from what I hear from the banking community, it's really difficult to make those kinds of changes in a bank.
Sure.
But that's what you obviously need to compete with the fintechs.
Yeah, I would say from a data perspective, it's, there are a lot of data vendors now in the market that can help you understand how to target a consumer better, right? It doesn't necessarily it could come from a bureau, it can come from a non-bureau, it can come from ICE, there's
Sure.
a lot of data out there, but it's not being leveraged in a meaningful way. And so doing the correct sort of demographic selections and the audience selections and understanding that different consumers in different markets with different characteristics and different bands and age groups are going to respond differently. And then if you've got sort of the data science sophistication at your institution, then producing custom models, right? And retraining and feeding those models new data, and then leveraging those models to actually action and target different types of consumers and segments is really the future of where a lot of marketing is going, if it has not already.
Yeah. One of the things I would add is efficiency is number one for all institutions that we talk to right now, whether it's AI automation or whatever the case may be. Doing more with less is absolutely paramount. Flexibility is a big one that we hear a lot, right? Being able to service and first and seconds on the same platform, originate first and seconds on the same platform, be able to move with the market as things ebb and flow. Right now, it's shifted more towards the HELOC space for all the reasons that we've been talking about. Folks that have taken out low interest rate first in the past, where HELOCs make sense. But if 30-year rates dropped 1% overnight, it would move to a cash out refinance market, right?
Sure.
So being able to ebb and flow and take advantage of the market as things flex is one that we hear a lot.
Yeah, that makes a lot of sense. And I think, as all of you on the committee, how do you think about taking your knowledge and expertise as committee members and taking those insights and helping share them with member banks at CPA so that they can use them in their business?
Ours is a lot about sharing insights, right? Sharing strategy, kind of listening as much as we talk on the ICE side, making sure we understand what folks are looking for and make sure we implement those in our solutions. And then from a data standpoint, which I kind of live and breathe on a daily, weekly, monthly basis, kind of share as much insight as we can so participants really understand the market to the greatest degree possible and can make informed decisions.
Yeah, I would say go to Andy for the macro level insights. Come to me because we can find you the right consumer. We can give you all the risk criteria, the credit data, right? And
Go to Sam for
Yeah,
the
go to
industry
Sam.
trends.
Yeah.
Get a little covered it all here. Kind of shifting gears a little bit, we've been talking a lot about kind of the industry and what the banks and various data providers are doing. But as far as it relates to kind of maybe regulatory or legal or kind of rules around HELOCs and related products, what advocacy efforts have been most effective in kind of shaping both perception and public policy? Or like where are you focusing or seeing a lot of attention in certain areas?
That's a good question, because you think of, after the crisis, nobody wanted to get home equity loans. They just had such a bad image.
Sure.
It took this long just to start getting any kind of momentum. And I think that's probably part of the holdup that we've had since then, why we didn't see the growth like we did with equity itself. So my perspective on that.
I mean, from a policy perspective, there's the Home Buyers Privacy Protection Act, which was recently passed. And so what that I think does is it creates a unique opportunity for banks and financial institutions that have an existing relationship with their consumers to be able to target them into the future. And for those that are not aware, the Home Buyers Privacy Protection Act essentially curtails the usage of trigger leads to target consumers for marketing, for credit offers, without the four exemptions. And one of those exemptions is a financial depository institution that has an existing relationship with their consumers. So I think what it really does is that it shifts sort of momentum to a different part of the industry, right? So I think big banks now can better benefit from some of these trigger leads because they're generally in a position to be able to leverage them because they have a larger consumer base that they can tap into. So I think from that perspective, especially whether it be HELOC or general mortgage lending, I think there have been some recent policy changes that I think can benefit a lot of banks.
Yeah, and again, another reason to use their data and know what data they have to be better able to target their existing customers and deepen that wallet.
Yeah, and I mean, that is the attraction for big banks, right? They're largely a wealth entity, and their leg into the mortgage industry, and they've told us this several times over the last few years, is we don't really want to be in the mortgage space. We want to serve our client base to the best of our ability, right? And so obviously that's a big benefit to them.
Great. Well, I think, I guess to close, I'd be interested, and it is great that between the three of you, you have kind of different perspectives and work in different areas of the industry, but what's a home equity trend you're watching most closely now? And maybe I'll start with Sam.
It was really interesting last year. We saw, and I watch a lot of non-bank securitization activity, and we saw a lot of CES, closed-end second mortgage, increase. A lot of volume in there. Now, recently, with the way rates have gone, it's going the other direction, and HELOCs seem to have picked up recently, and closed-end seem to have slowed down. So just a shift that's happening between closed and open-end.
The big one for me is, and we talked about this earlier, the growth in the pie, the size of the pie, if you will, the available equity out there has really slowed down. So my focal point here over the next few quarters is withdrawal rates per capita, right? And we've started to see that pick up a little bit. Interest rates have come down across the board. They've certainly come down on home equity lines of credit over the last couple of years. Seeing where that settles ultimately, I think is going to be really important. I think that's a good opportunity for maybe some growth in the industry there. And then credit availability as well. We're seeing a shift in the credit cycle here. Do we see any expansion of credit? We really haven't seen it yet. It still remains a very high credit product. Do we see banks and even non-banks start to open up that box a little bit to pick up some volume here over the next few quarters? I think that'll be an interesting trend to watch.
Great. Yeah, and I think certainly a lot depends on what happens with the macroeconomic environment too, which I think is anyone's guess where we stand right now. But well, thank you all for being here. Certainly appreciated hearing all your insights on the HELOC market, and appreciate you taking the time to join us today.
Thank you.
Thank you. It's a pleasure.